A key regulatory cloud just lifted over Wells Fargo. What does the Fed ending an enforcement action actually mean for your portfolio? Here's the context. The Federal Reserve Board has terminated a specific enforcement action with Wells Fargo. That means supervisors decided the bank met the defined requirements under that order. It does not change interest rate policy, but it can change how investors view risk, lending capacity, and strategy at a major U.S. bank in a shifting rate and inflation environment. Think of enforcement actions as formal fixes to problems in risk management, compliance, governance, or consumer practices. Termination signals the Fed has verified remediation is complete and controls are stronger. For Wells Fargo, this narrows a slice of regulatory overhang. It does not speak to other supervisory matters or to monetary policy. It is a point of progress, not a performance forecast. Why investors care comes down to valuation, funding, and flexibility. When a large bank closes a chapter with regulators, uncertainty tied to that issue declines. Lower perceived risk can influence equity multiples and credit spreads over time. Stronger controls may support steadier operations and clearer capital planning. That can shape decisions on lending growth, technology investment, buybacks, or dividends, subject to other limits that may still apply. This feeds into the broader mosaic for financials. Bank fundamentals hinge on balance sheet quality, cost of compliance, and the trajectory of earnings in a sensitive rate backdrop. Sector ETFs and bond markets watch these signals because they affect expected returns and downside scenarios. A termination is not an earnings event, but it can reset assumptions used in models across stocks, ETFs, and fixed income. What to watch next is execution. How does Wells Fargo deploy balance sheet capacity while rates, inflation, and credit conditions evolve? Do funding costs and deposit trends stabilize or improve? Do operating expenses reflect sustained compliance investments without eroding margins? Do credit metrics stay resilient as growth slows or accelerates? And how do peers progress on their own remediation paths, which can influence sector multiples? Here's the practical takeaway. Treat this as incremental clarity, not a green light for aggressive risk. Revisit your financials exposure with fresh inputs on governance progress, capital flexibility, and earnings sensitivity to rates. Diversify across instruments if you use sector ETFs. In bonds, reassess spread compensation versus updated regulatory risk. Anchor decisions to your time horizon, risk tolerance, and the macro path. Want the deeper dive in full context? Read the full article at finlitica.com.